Hello again, class. This is a video tutorial of some of the problems at the end of chapter 13 from the Fundamentals of Corporate Finance text, 3rd edition by Perino, Kidwell, and Bates. And in this video tutorial, I'm going to go over problem 3.1, 3.5, 3.7, 3.9, and 3.11, and one of these is going to be optional. I had an opportunity to dig a little deeper into how the formulas worked for one of these problems, and I don't think it's appropriate for this level of finance, but we'll get to that one in a sec. But for now, let's get started. Problem 13.1, Finance Balance Sheet. Neiman Markup Company has total debt obligations with a book and market value equal to 30 million and 28 million respectively. It also has total equity with a book and market value equal to 20 million and 70 million respectively. If you were going to buy all of these assets of Neiman Markup today, how much should you be willing to pay? So what's given from the formula is this. We know that the capital component, we have debt and equity. The book value, we have given from the problem, 30 million. Book value, equity is 20 million. We have a 28 million market value here. And 70 million, all of that is given from the problem. So all we do, first you want to add up your two book values, the 30 million and the 20 million, and you get 50 million, right? And in order to answer the question, how much should you be willing to pay, the only thing that you have to do is just add up the two market values, and that's it. So there wasn't really a whole lot to this one. The answer is 98 million, and if you confirm with the back of the book, that's it. So not much to it. All right, so now problem 13.5. So let's hide this for a sec. All right. Cost of common stock. Whitewall Tire Company just paid a $1.60 dividend on its common shares. If Whitewall is expected to increase its annual dividend by 2% per year into the foreseeable future, and the current price of Whitewall's common shares is $11.66, what is the cost of common equity for Whitewall? Okay, so now as we're getting a little bit more into the latter chapters of the textbook, you're gonna see a lot more formulas than you did in the first couple chapters of the book, a lot more Excel work. Just so that you know, at this point in the class, you're gonna come across a lot more formulas, and I am totally okay with you going online and finding like a those calculators. So like if you find one that will, like a cost of common stock calculator, you can use that to come up with the answer. Well, of course, the answer is in the back of the book for these anyways, but as long as you show me your work and show me the Excel way of reaching that answer, then then I'm okay with that. Because my main objective is just ensuring that you can apply Excel to finance, and that's really what I'm looking for. So now, what's given from the problem is we have the dividends just paid. Let's call that D0, $1.60. Dividend growth rate perpetual, 2%. And the current stock price is $11.66. So what we do to find the cost of common equity is we just use what's given here. So you do equals, and then parentheses, open parentheses twice, the dividend just paid times, open parentheses again, 1 plus the growth rate, close parentheses twice, divided by the current stock price, close parentheses, plus the perpetual growth rate. And then when you do that, you end up with 16%, which is the answer. And you can confirm with the back of the book that that is the answer. So just so that you know, I also wrote it out here in case it makes more sense. The common cost of equity, which I just abbreviated CCE, this is just for me. I mean, I don't know if maybe the textbook I don't think the textbook abbreviates it like how I do, but CCE equals the dividend just paid, which we had, times 1 plus the dividend growth rate, close parentheses, divided by the current stock price, close parentheses, plus the dividend growth, right? So you can, like I said, you can totally use the calculators on the websites. Usually, the financial ones will always tell you how the formula works also. So you can definitely use that, and then be creative in applying that into Excel so that you can get to your answer and show your work also. Um, so in the calculator website, calculate the next year's dividend price first, and use this. If you're gonna be if you find the calculator website, in order to reach this, you want to use this for the next year's dividend, $1, 1.632 cents, and you should come up with the same answer. All right. Now, this is the one that I am going to leave optional. Not necessarily for extra credit, because I don't want you to burn out trying to figure this all out. This one is a little bit more complicated, and this one is what we call the two-stage model, which is in chapter 13. You'll find the multi-stage model, and that's kind of like the one that you want to be looking at, and I can give you the page number exactly. What you want to look at, and hopefully your book is the same as mine, because I don't have like a faculty version or anything like that, but there should be on section 13.3, titled the cost of equity. You should have something on the bottom of page 427 that says using Excel, solving for K using a multi-stage growth dividend model. And that's kind of like what you really want to be doing here. This is one of the other ones where we're going to be using algebra to solve for one of the variables. So the question reads, cost of common stock. Two-stage Rocket's common stock is expected to pay an annual dividend equal to $1.25, and it is commonly known that the firm expects dividends paid to increase by 8% for the next 2 years, 8% 2 years, and by 2% thereafter. If the current price of Two Stages common shares is $17.80, what is the cost of common equity capital for the firm? Okay, so this is the formula that you have to use, and it's written out in Excel, and you replace what's given within the formula, and eventually you get this. Now, a cleaner way to look at it is if you look at it like this, right? So this is essentially right here the same as this, and what you're trying to do in this formula is to solve for K. So when you use everything that's given, and I can copy this over, maybe it'll make more sense up here. If you look at the problem and you replace this formula, right, with the proper variable, this is what you get. So let's see if we can conceptualize what this is, right? So P is going to be equal to the current stock price. This top part here, D0 parentheses 1 plus G1, is going to be the dividend after the first period times 1 plus the growth over 1 plus K. We still don't know what K is, right? All right, so now let's look at this second part right here. It's essentially the same thing. Why is it the same thing? Because we're having the same amount of growth for 2 years. So this is the growth rate in the first year, the second year, and then something happens thereafter, right? It's not 8 years back to back. It's it's not 8% consecutively. It's 8%, 8%, and then 2% thereafter. So in order to calculate that, let's look at this part of the formula now. So it's DO 1 plus growth period 1 squared times 1 plus G2 over K, which we don't know yet, minus G2, which is the growth in phase 2, close parentheses, open parentheses, 1 plus K, which we don't know, close parentheses squared. Okay, so we replace these with what's given. So 125, which is the expected dividend in the expected dividend times, and then we do this is basically the growth of the first period squared times, and then we do 1 plus, and then the growth in period in the second phase. So we do 1 plus, and then 0.02, which is 2%, right? And we put that over K, which we don't know yet, minus G2, which is again the 2%, open parentheses 1 plus K, which we don't know yet. Okay, so now this is as far as I'm going to walk you in this problem. In the event you want to really try to move forward and try to figure it out, my recommendation would be to focus a little bit more on the continuous model and not so much the multi-stage model. In finance, there's a lot of debate about the accuracy of the um, multi-year model like this one. Usually we'd be looking at constant growth as a more stable figure. But if you'd like to go ahead and give it a shot, you're more than welcome to do it. These are one of the problems where it's going to be trial and error. And just make sure that in chapter 13 you read the section over, you watch the videos, and you try your best. All right. So the answer for this one comes out to be 9.82. And you really just have to play around with the figures, and this is one where you have to do a little guesswork to see. So don't try to stress yourself out too much if you don't get it. If you choose not to do it, you can just write a little note here and make it yellow and just say you said it was optional, apostrophe or exclamation mark, and I'll take it from there. But if you want to give it a shot for the purposes of your own practice, you're more than welcome to do it. And this is really going to be what you're going to be working with, okay? And if you do want to give it a shot, it's okay if you want to just show your algebra here. All right, I'll take that for credit. All right, 13.9, cost of preferred stock. Chrysler Autos has preferred shares outstanding that pay annual dividends of $12, and the current price of the shares is $80. What is the after-tax cost of new preferred shares for Chrysler if the flotation issuance cost for a new issue of preferred are 5%? So what do we have? We have given, we know that the annual preferred dividends is $12. We're getting that from here. The current preferred stock price is $80. We're getting that from here. And the issuance cost is 5%. So what we're trying to figure out is the after-tax cost of the preferred stock. Not hard. All you do is equal the annual preferred dividend divided by, open parentheses, the current preferred stock price times 1 minus the issuance cost, close parentheses twice, and you end up with 15.79%. And if you check with the back of the book, they have 5.8, but this one is more accurate, I think. So then there you are. Now, question 13.11. The weighted average cost of capital for a firm. Capital Co. has a capital structure that is financed based on current market values with 50% debt, 10% preferred shares, and 40% common shares. If the returns required by investors are 8%, 10%, and 15% of debt, 15% for debt, preferred shares, and common equity respectively, what is capital's after-tax weighted average cost of capital? Assume that the firm's marginal tax rate is 40%. Okay, remember I told you earlier today that from this point forward we're going to be seeing a lot of formulas. Try not to lose any hair over figuring out why the formulas work the way that they work. Just roll with it, respect the formula, and just take what's given, plug it into the formula, identify what you don't have, figure that out, and then solve. So now this is the formula for a weighted average cost of capital, right? So then we have WACC equals X debt, K debt, right? 1 minus T, close parentheses, plus X, BSK, PS plus XCS, KCS, right? It's a lot of letters going on there, right? But we can totally pack that down into an Excel formula. This is how we do it. So let's look at the formula as we go through the Excel formula, all right? We do equals, let's zoom in. So we do equals, open parentheses, D9, which is going to be your 50% debt right here, times E9, which is this. So now we've solved for this, the X debt, K debt. Okay, that's what we just did right now. Open parentheses, 1 minus, and we're addressing this part here, 1 minus D13. So then it's 1 minus the marginal tax rate. All right, close that parentheses. So we've addressed this far so much, and we're putting all this in one parentheses so that it can address this part first. So now we do plus. Now the next part, we want to put it in parentheses also. So let's look at this part here, X, PS, KPS. So we're looking at D10, which is the preferred stock, right? The weight of the preferred stock times the return offered to investors. So we just addressed this part now. All right, we're putting that in parentheses because we want it to be answered first per order of operations, plus, and then we're going to do the next part of it. So then plus, open parentheses, common stock, times the 15% return offered to investors, close parentheses. And that's it. And the reason why you do it like that is because each one of these have a separate weight. If you were curious, if you add all of these up, you get 100%, right? So then this is the weight and the return offered to the investor. So then it's all you really do is if you organize it, you put it side by side, you just go back and forth, right? And that's all you really do to calculate the weighted average cost of capital. And that's it. So now you know in the event you have another problem that asks the same. And this concludes the video for chapter 13 for a few problems from the Fundamentals of Corporate Finance text, 3rd edition by Perino, Kidwell, and Bates. And as always, if you have any questions, comments, or concerns, please feel free to reach out. Thanks for watching.